Welcome to Trading Nation. I'm Mike Santoli. The U.S. and China firing billion-dollar shots in the escalating trade war this week. And our next guest is ready to declare a winner. Steve Chiavarone is portfolio manager at Federated. He joins us now to break down why he thinks the U.S. is winning the trade war by the numbers. So, Steve, obviously the markets have maybe they kind of priced in whatever effect there was going to be. Pretty positive verdict on the early outcome here between the U.S. and China. Why do you think the numbers tell you that we can declare a winner at this point?
Well, I mean, look, I think the market, first off, has been pretty reasoned through this. You know, the market, although it responded to the initial trade news, back in March with a little bit of concern, has generally been pretty level-headed. Look, you vote with your dollars, and you look at the U.S. Market since the start of the trade war, and it's done quite well. China really hasn't. And when we add up all the impact of tariffs, they come up to just a fraction of the stimulus being added into the economy in the U.S. And I think the market's really starting to ferret that out.
Certainly the market has been able to kind of say that any effect can be absorbed, certainly in the short term. But does that mean that long term, as a policy outcome, whether it be concessions by China or anything, that the market is sniffing anything out? Or is the market just saying, maybe this is a negative down the road, but there's enough else good going on that we can buy them here?
Yeah, look, I mean, I think the big concern for the market was, do we have an administration that's trying to tear down the global free trade system? It's hard to stay with that argument. We've signed a deal with Mexico. We've got a handshake deal with the Europeans. We're likely days away from a deal with Canada to kind of solidify a new NAFTA deal. So what we've seen on those fronts is an administration that's using pressure politics to get better terms of trade. That's fine. China, we think, is a little bit of a separate case. We think this is really tied to the Industrial Revolution that we've talked a lot about, where there's key technologies, automation, AI, robotics, Internet of Things, 3D printing, blockchain, which are really based on American chip superiority. If you control the technologies of the next industrial revolution, you're going to be the world's preeminent economic power. We control those today. The Chinese would like to, and therein lies that conflict. So I think that conflict lasts a bit longer, but ultimately I think it's something that the market feels is worth us exploring, or at least defending.
So where does that leave you as an investor in terms of trying to position, let's say, going into the end of the year, in terms of where you'd like to invest either within sectors in the U.S. or even U.S. versus the rest of the world? Because as you've pointed out, non-U.S. markets got beat down a lot more during this trade fight than the U.S. has.
Yeah, I mean, I think, look, the U.S. still remains a very attractive place to invest. And in fact, we've been overweight U.S., at Federated for virtually the entire year. I do think, though, that the headlines on trade are likely to get less bad and even potentially better. Again, we think that you're going to have a NAFTA deal. We think there'll be more good news forthcoming relative to both Europe and Japan. We'll see what happens on the China front. Again, though, they don't have anything else left really to tariff. It's interesting. We went with another $200 billion worth of goods just yesterday, and the Chinese only responded with 60. So I think, again, we're kind of exhausting what you can do on the tariff side there. So we think you have the potential for sentiment around the globe, in the U.S., but also internationally, to get better. We think that the Fed may pause in 19. That could take some pressure off the dollar. We think the trade headlines could get a little bit better. And so we remain steadfast in our bullish view in the U.S., but we're itching to get a little bit more positive internationally as well.
And just to quantify that bullish view about the U.S., we have the broad indexes kind of holding near their highs for the year. How much more do you think they might be able to run?
We've been real consistent on this. We think that the S&P can move to 3,100 by the end of this year on its way higher next.
3,100. Okay, so that's another 200 points up from here on the S&P 500 if things go your way. Steve, I appreciate your time. Thank you for joining us today, and thank you for watching Trading Nation. I'm Mike Santoli, and we'll see you next time.